Okay, we are back. I'm very happy to be talking to John O'Connor, who's the president and chief investment officer of a money management company called 3D Asset Management. John, a real pleasure to have you.
Hi, Doug. Thanks so much for asking me on.
So tell me, what is the 3D all about in 3D Asset Management?
Well, we use it metaphorically. We, as opposed to viewing a picture or a photograph of something that looks the same from every angle, we view investing as kind of multidimensional. We have our own view of it, and we dive into the weeds and get very technical and do a lot of asset class analysis and then eventually security analysis to build portfolios. But we realize since we work exclusively through advisors, they've got their own view of it. They're approaching client goals and challenges in a unique way in every situation. So we've got to take that into consideration when we're working through our investment process. And then ultimately, investors or the end clients look at what it is they're provided from a different angle than either the advisor or we do. So we have to take that into account. We try and take a very technical, complicated process, make it simpler to explain, and then ultimately easy and service-friendly to deliver.
Okay, so John, in real life, I'm a financial advisor, and I actually work with money managers all the time. But a lot of the terms that you just used, you and I might throw around all the time, like the advisor and the manager and the client. From an end user standpoint, from someone who's listening to the show today, what would his relationship be with a company like yours?
Well, oftentimes we'll have a direct contractual relationship, which means that we're a fiduciary. We've got an obligation, to put the client's interests first. But we always do that through someone like you, a CFP or a financial advisor that knows that client, that married couple, that retiree, that corporate executive, knows their situation, their goals, their aspirations, their risk tolerance, knows that inside and out that an investment manager can never know because we don't sit down with the client on a regular basis. We base our management on the information you provide us, really.
Okay, so then what makes a company like yours different from, for example, a client buying a mutual fund, or just, I know that you're very involved in ETFs, exchange-traded funds. Why wouldn't the clients just go ahead and buy those?
Well, again, our accounts are separately managed accounts. We've got a few ways to get them to people, but most of our money is managed with well-known custodians. Charles Schwab is an example. So an individual account sits at Schwab. And then if there's any differences between, say, two of your clients, you let us know that, and those two accounts might be managed slightly differently, or might have, if somebody's got, say, some municipal bonds they want to hold outside of our managed account, we can also put that in the Schwab account and report on it. As opposed to just buying shares of a mutual fund, those shares are going to be identical regardless of the client's age or risk tolerance or position in life or their goals or anything like that.
Okay, so the term separately managed account, could you dive in a little more and just explain what that really means?
Sure, it's one of those things that are functionally named. So it's a brokerage account held at like I say, a well-known custodian like a Charles Schwab, and it's in the name of the client, and the client will get, the investor will get every month a statement from Charles Schwab, either physical or online if they prefer. And so it's a separate account in their name, but we've got the authority through the contract that they've signed with us to go in and do trades and cause, say, a check to be sent out if that's something that the client is looking for, or money to be moved from one place to another, always with the client's authorization. So it is a separate account that's managed by 3D.
Okay, so the way that I often describe this model of having money managers handle a portfolio is I'll tell a client, Mr. Client, you are like the president of your own company, your family, Inc. And you hire someone like me as the CFO, the Chief Financial Officer, to help you and advise you in dealing with the money and whether there's stocks or bonds or real estate or financial planning. I serve in that capacity. And then it's my job as the CFO to find managers to handle the day-to-day operations of the buying and selling. Do you think that's a good way to describe what's going on?
I think that's a great analogy. We describe ourselves to advisors and end users as somebody's outsourced investment analysis and investment services department. So, you may use a technology firm to outsource, the maintenance of your networks. A lot of advisors use us to outsource the research and development involved with the investment process, and then even to the extent that the trading and the reporting and the client account, the actual account administration, it falls on our shoulders as well. So it's a great way to run a business. I know we outsource several things as well. Our technology is one, and a few others. So it's an efficient way to run a firm.
World of outsourcing. We are talking with John O'Connor, who's the President and Chief Investment Officer of 3D Asset Management. He's been talking to us about how investors use institutional money managers to handle their portfolios. So John, let's dive a little bit more in. Let's say that someone comes along, a financial advisor, he says, I've got a retired client, we've done a financial plan, we want to have half of his portfolio in a global equity portfolio and half in bonds, and we'd like to assign to you the global equities. When you get that assignment, how do you know what to buy?
Well, we use exchange-traded funds, or ETFs, as our primary means of accessing the various markets around the world. We take the information that you've provided us on your clients' goals and risk tolerance and objectives, and what we try and do is we build a globally diversified portfolio that's going to shoot for a targeted rate of return with a managed amount of risk. And in plain English, we're trying to access opportunities around the world. So, and that's easy to do, the way we do it with 15 or so ETFs, exchange-traded funds in the portfolio. We can invest across 45 countries in around 10,000 underlying stocks, large stocks, tiny stocks, and with various kind of financial fundamental tilts associated with them. It's all index-based, fairly low cost, and very, very efficient.
So would you consider yourself active managers or passive managers?
Well, we certainly use passive products. The exchange-traded funds we use are all index-based in some way, shape, or form. We are what we refer to as strategic managers. So we've got a strategic asset allocation, but it's not quite set it and forget it. So based on changes in various economic events or market events or financial events around the world, we'll adjust the portfolio. We'll always be fully invested. So in the example you gave, if you're hiring us to manage the equity or stock portion of someone's portfolio, we'll always be in the markets, but we might be more in the U.S. markets than we traditionally are. If we think the U.S. is and as was the case, led the world out of the global recession. Or we might be in more small caps than our normal model would be if we think there's more opportunity in small cap, small stocks. Recently, on the bond side of our portfolios, we shortened up the average maturity in the bonds because we feel the longer bonds are going to see, with interest rate rises, bond prices fall, and we want to prevent the portfolios from dipping as a result of that.
A lot of people claim, and there's certainly a big debate in the industry, about whether tinkering with a portfolio adds value or subtracts value, or is just kind of value neutral. How do you see the different arguments on that?
Well, I mean, we base all of our investment process on academic studies and over long periods of time. So we don't, while we don't actively manage, we do rebalance periodically. I mean, everybody, I think, would agree that ideally you want to buy low and sell high, and by rebalancing a portfolio back to its target periodically, you'll be doing that. So you'll sell your overpriced asset classes, and you'll be buying in to asset classes that have maybe depressed in value.
So how often do you do something like that?
Usually we rebalance annually, or if an asset class or a particular part of the portfolio has gone outside of its determined tolerance range.
I see. So if something really moves in the market, if something turns sour and you no longer hold by it, you would get out of it. You wouldn't wait till the end of the year to trade it off.
Right. Yeah. Exactly. So we don't try and predict markets, but we do see trends develop, and we do understand changes in the global macro environment and even regional changes around the world.
Okay. And when people look at a portfolio, or sometimes people will want to say that, well, that's a conservative or that's an aggressive or moderate portfolio. Do you find those words are appropriate to use when looking at in a portfolio that you would manage?
I do, and the one thing I disagree with when a lot of people talk about it is where diversification comes into that equation. So what we'll do, a conservative portfolio will, with us, by its nature, have more bonds than stocks, and today more short-term bonds. But if somebody says that it's a conservative portfolio, so you shouldn't have small stocks or emerging market stocks, I would vehemently disagree with that. You should have them because of their, to put it in layman's terms, they're going to be zigging when large stocks are going to be zagging, and that, by definition, decreases portfolio risk. So that's the way we view risk management in a portfolio.
Okay. All right, well, this has really been very fascinating. We've been talking with John O'Connor, who's the President and Chief Investment Officer of 3D Asset Management. John, in the last few seconds, just tell us, how can people follow your work?
Well, the best way, we think, is to call their advisor and ask them about it, because that's the way we work with clients. But we do have a website. It's www.3dadvisor.com. We're always happy to talk to people, but we'll typically refer them to an investment professional that can get to understand their goals and objectives.
Great. Okay, John, thanks so much for your time.
Thank you.
You've been listening to the Goldstein on Gelt show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt show.